morning, everyone, and welcome to today's episode of Morning Coffee with Emerica. Today with me, I have Jay Richardson. He's a friend, someone I've worked with over the years. And Jay, can you introduce yourself, please?
I'd love to. Jay Richardson, and I am a mortgage loan officer. Been in the business for quite a while, over 25 years now, and known Emerica for probably 4 or 5 years.
Yes.
And we've done this a few times, but it's been a while.
Yeah, you've helped some of my clients go through some of the hurdles. I'm sure some of them would love to see you. We'll be happy to see you here now. And I know you just changed companies. Tell us a little bit about your new company, where you are, and what you have for us.
Sounds good. Last year, I started to work for Bank of Charlestown. And
All right.
at Bank of Charlestown, it's a bank that's located out of West Virginia, but they have several offices that have moved into the Northern Virginia area.
Okay.
And the reason why they hired me was they wanted to get more exposure and more clients in the Virginia area. So I know that's mainly where your clientele buys. Yeah. But we can lend in Maryland, Virginia, and DC. We have special loan bank products for just the local area.
Okay, that's good. That's great to know. Let's dive in and see. A lot of people have questions when it comes to the mortgage lenders. They're hesitant to get started. What are some of the pitfalls you see people go through when they're looking for a loan?
That is a big question. So I'll try to break it down for you.
Okay.
Because pitfalls can be from the very beginning of the process, like they don't know where to get started. So you want to buy a home, but you don't know where to even get started. So like that's a pitfall.
Yes.
Another pitfall is I'm not exactly sure what I'm doing. And so there's like this educational process. So a lot of times people just need to be educated on here's the steps. Here's basically what you need. Are you at least to this point with us? Other pitfalls are they didn't realize that credit was an important part of the pie. They didn't realize that the way that they pay themselves on tax returns or not on tax returns is another pitfall.
Okay.
Do you want me to keep going?
No, that I know there's so many of them. It's good. And that's one of the reasons I tell my clients, let's get started as early as possible. Because some of these things you can't predict. The educational part we try to help with. But once you get to talk to the lenders, when you get to find out what's in your credit report, what you need to do, even if you're pre-approved today, with the help of a lender like you can then tell them how to work to get to a better interest rate somewhere down the line. That's right.
Yeah.
Right? Okay.
And one thing that you do, which not all real estate agents do, is Emerica pays attention to the loan products that are out there, new things that she's hearing about. So you've even educated me on stuff that's out there that, our institution didn't have.
Yeah.
That happened to help another one of your clients. So
yes.
I think about that. Not all real estate agents pay attention and really get involved with that, but you do a great job with that.
Oh, thanks, Jay. Thanks. I try to go into them to make sure I'm able to help my client because I have such a diverse client base to make sure we're able to provide for every group that's out there for me, whether it's first-time home buyers, whether it's investors, or whether it's foreign national. Talking about products that are out there, what do you have right now that you think would be great for some of my clients out there?
What about first-time home buyers? You want to start with that?
Yeah, we can start with first-time home buyers.
Okay.
Yeah.
So one of the obstacles for first-time home buyers, other than the pitfalls that we just talked about, is having enough money for the down payment and closing costs. In Virginia, just for an example, you need about 2 to 3% of the sales price for the closing costs. And, a $500,000 home, that is $10,000 to $15,000 that you're going to need just for the closing costs. And so the difficult part for first-time home buyers, sometimes they don't have enough money saved.
That's true for a lot of people. Yeah.
So there are loans that have 0 down, and there are loans that have 3% down or 3.5%. Those are the most common.
Okay.
Did you know that FHA is the most popular first-time homebuyer program?
Yeah. Yeah.
Oh,
yeah.
Okay. I didn't know that.
Yeah.
And did you know that 33% of the people that buy so far this year and last year are first-time homebuyers?
Yes.
Okay.
Yes.
All right.
Yes. Following the market trends.
Didn't know all that, but a product that we have that is, I think, unique is a 1% down conventional loan.
Okay.
So I just mentioned FHA. FHA is more of a government loan, and there's extra fees sometimes with that type of loan. So the down payment is a part of it, but sometimes these programs have restrictions on income and they have restrictions on, or they have extra fees.
Okay.
So not the down payment, but the closing costs that I was just talking about can go up in those situations.
Yeah, sometimes they go up to 5%. Funnily, I've seen
Exactly.
closing costs go as high as 5%. Yeah.
Right. So even like a zero down loan program I saw with a credit union, they actually had an extra 3% in fees.
Okay.
So I was like, do you really want to put zero down and then pay all these extra fees? So that's not something you should.
So with a
do.
1% down, is it 1% down just on the down payment? Do you still have the closing costs you have to deal with?
We do. We do.
Okay. Is it less closing costs when you do the 1% down versus doing the zero down?
Yes.
Okay.
And the other good part about that 1% down program is the mortgage insurance. And that's when you're putting less than 20% down, typically you have something called mortgage insurance.
Private mortgage insurance.
Private mortgage insurance. And what that does is that covers the lender in the event that there's a default. So most people in those situations, you're going to have it. But guess what? That fee, cost of that fee can be, there's a big variety of lower credit scores. Different loan programs have different fees.
Okay.
All right. So, for example, FHA does have one of the bigger fees for that first-time home buyer program.
Okay.
Our 1% down program has a mortgage insurance cost that's associated with a 3% down. So you're only having to put 1% down, and the cost is associated with something more like a 3% down.
Okay.
And another pitfall or restriction that first-time home buyers have, that 0% down loan that you were talking about, has income requirements. So if you make too much money in certain counties, you can't get a zero down program.
All right. Yeah.
Our 1% down program has no restrictions on income.
Okay.
Big factor.
All right, that's good. So if money is an issue with a 1% down payment, we can get you into a house. And with the market the way it is, we probably could still be able to get some closing costs for you. So you really would be walking into the home with probably 1% down. That's great to know. What effect does credit scores have on loans in general and on this particular one?
Okay, so loans in general, I don't know of any investor that will do a loan that has 500 or 550 credit scores. You can do that. There are special investors that will do that. But credit scores as low as 500 and usually as high as 800. That's sort of the range.
Okay.
The lower the credit score, typically the higher the cost.
Okay.
And the more complicated it is to get a loan approved. I would say 620 credit scores and below have a risk of potentially not being approved through an automated system. So most lenders have an automated system that we use to pre-qualify or pre-approve people.
Okay. Yeah. All right. So you're saying with 620 and below, it's more difficult. Do you get a better interest rate if you're 620 and above? And when do you get the best interest rates out there?
Yeah. It depends on the loan program.
Okay.
So conventional loans that are associated with Fannie Mae and Freddie Mac, those are the ones that are most credit score sensitive.
Okay.
So you asked the question, like, who gets the best interest rates? 780 and above credit scores. So 780 to 700. That's another range. Below 700 gets a little bit more expensive.
Okay. Over the years, I think I've heard lenders say 680 plus you can get a decent interest rate. Would you say that?
Yeah.
Okay.
Yeah, if I see 680 and above, those clients typically are going to get a good interest rate. The mortgage insurance is more expensive for 680 to 700, but for certain types of loans.
Okay. A bit of what I'm seeing lately are people with student loan issues on their credit. What can they do to go around that to make sure it doesn't hinder them from buying?
Well, they should know when the loan itself is required to start paying.
Okay.
I've seen them where they thought that the payment was going to continue to be deferred.
Okay.
And then they didn't realize that they had to start making payments. And I don't think the communication between these student loan sources and the owners of the student loans is very good because there is a lot of confusion.
Yeah.
I've seen people that were 6 months past due And they said, I was supposed to make payments starting in January and I haven't done that yet. So really pay attention to when you have to start making payments on that.
Okay.
You don't have to pay those loans off. You can have student loan debt when you buy a home. That's another question that we get on a regular basis.
Okay.
But
all right. What do you think every buyer should know before they even start the loan process?
You can be fooled and you can get wrong information if you don't validate the source of who you're working with. And then also the opposite is don't be so nervous to talk to somebody and feel like you have to try to do all your research online through websites, because not everything that you read online is accurate.
Okay.
And not every professional is going to care that much about the person and what they're doing and their expenses and, their goals. They may just see them as a transaction. So I would say that's kind of the big thing to be careful.
That's true. That's true. How would you guide clients who are deciding between waiting or buying now? How would you guide clients that way? Because I have a lot of people thinking, oh, maybe I should wait for rates to drop, or maybe I should buy now.
I hope you're going to answer this with me, because
yeah,
that is really like the big question that we get
Yeah.
right now. So I think if you ask somebody whether they think homes are going to cost more next year, 6 months from now, or now, most people are going to say, well, houses will probably cost more next year than this year. So,
I think I would say homes would cost more next year, because the trend so far over the years, when you look at it, especially in this area, not nationwide necessarily, but in this area, the trend is it keeps going up because we do have limited homes in the area.
Yeah, we're on track for having appreciation of at least 4%. In certain areas, it's even higher. In other areas, it's a little bit lower. That's been very consistent. And most people don't realize that there is a huge demand of homeownership that has been backed up between COVID, between not having enough inventory. There's a lot of individuals that are ready to buy, and they're just waiting for something to happen. So if you have the option to wait or buy today, I would say buy today.
Yeah.
Get in the marketplace.
I always tell my clients to buy today and make them understand that it has nothing to do with me selling you a home or getting a commission. But because the prices do keep going up, you can always refinance if rates drop, because people hedge their bets saying, oh, but we think interest rates are going to drop. Yeah, there's a possibility of it dropping. But I know you had one of those programs before. I don't know if you still do, where if they buy and within 6 months rates drop, they can refinance with you. Do you still offer that?
We still offer that, and we'll do it with one time, no cost.
Okay.
So they have to at least made 6 payments on the loan. And so, yeah, that's an incentive as well. If people just think, well, I would really like it if rates were another half lower.
So let me take us back a bit. So if someone buys, say in August right now, and rates do drop in September, which we're anticipating it might, after 6 payments, they can refinance at no cost, right?
Correct.
So even if the good thing with that is the rates have dropped, which means you're getting something lower. But if prices have gone up, which is what we expect to happen, you're still getting the house at today's price. So I think that's the way to go. What do you think?
Yeah, and to add what you said, if you bought a home in August and the interest rate was 7%, and the interest rate went to 6% in September, you probably don't necessarily need to wait 6 months. You can refinance whenever you want. So I want to make sure that's clear.
Okay.
1% off on a certain loan size, even if you have to pay closing costs, it probably makes sense to refinance. So
just off my head, what would about approximately, I know it varies, what would 1% on a loan, how would it affect your monthly payments in numbers? Can you?
Yeah, this is how I do the math for people.
Okay.
All right. If you have a $500,000 home and a balance, and you say 1%, you save $5,000.
Okay.
I divide that by 12. And so it's between $450 and $500 is what they're going to save.
Wow, that much.
So if do a $300,000 home, they only owe $3,000. They're going to save $3,000 divided by 12. It's more like 250 to 300.
Yeah, that's still a good number.
Yeah.
That's still a good number. So
The smaller the loan size, the more it makes sense to wait for a little bit bigger spread.
Okay, that's good to know. I know we've talked to our first-time home buyers.
today.
Yes, you did, and now I'm gonna
I'm
use
proud of
that.
You are. You're gonna look at the rate and you're gonna say, Jay, what's the rate
Yeah,
today? And then they're gonna say 500. You should
exactly. Then I'm gonna start reaching out to people who I'm like, I think you need to refinance. I think you need to call Jay. We've tapped into the first-time home buyers. What do you have for our investors out there? Because I have a lot of clients who are looking to double into investments. They already own their homes, but I'm encouraging them to start in the building an investment portfolio.
The most popular investment loan program out there right now is one that allows somebody to not verify income.
Okay.
A lot of times not have any credit at all.
Okay.
Don't have to be a U.S. citizen. And the trick is you have to put enough money down to make sure the rental income covers
the
mortgage payment.
So with that, even if you don't have the perfect credit score, as long as and even if you're an investor from overseas, no U.S. Citizenship, as long as the mortgage can cover the rent can cover the mortgage, you can get into that.
Right.
That's interesting to know. That's good to know. Is there any other thing needed to qualify for that?
Sometimes transferring money is something. So a lot of times they have to have a U.S. bank
account. Yeah.
Bank account. So that's a trick.
Okay. Is there a set down payment for that, or you just have to do the numbers to where the rent covers the mortgage?
I like where your brain always goes on this. I usually think 35%.
Okay.
But it's 30 sometimes.
Okay.
But, if you're an investor and you have credit and you don't want to go the route of a little bit more creative financing, 20% down is what you need. 25% down is the sweet spot because you've got way less fees. 25%. So 30 to 35 is, I think, that's
a good one. Okay. I think that's an excellent one for buyers who are abroad, foreign buyers who are looking to buy in the U.S. That's an excellent one. And also for business owners who probably don't have the tax returns or the income to show, so that would work for them. But for people who already own their home, who probably want to just keep that as an investment property and move into the next one, let's dive into that for a bit and see. What would they need to do?
You're talking about somebody that already has an investment property, they have their primary home?
No, they have a primary home. I'm encouraging some who already have a primary home to keep that home as an investment property and move into a new home so they get to put less down payment instead of paying 20%.
Yeah.
For, like you said, I'm always thinking out
the
best way to help my client.
That is a dirty little secret that not everybody knows about. So I'm glad you know about it. But if you want to buy multiple properties, there is an opportunity for you to put less money down if you're going to rent your current program or home out to somebody else.
Yeah.
So you can buy a home and move into that next home.
And that's what, like 5% down versus 20% down?
Typically, that's it.
Okay. Yeah. So if you already own a home and you're looking to start an investment portfolio, what you need to do is rent your current home and then find you a new home to move into, and you only get to put 5% down versus 20% down if you're buying the new home as an investment property. That's right.
That's correct.
How long do you have to stay in the current home before you can move to the next home as an investment property?
Good question. Has it ever stumped you before? Have you ever had people ask you?
Yeah.
Okay. So
is it 1 year, 2 years? Sometimes I'm confused.
It's one, like, we will not even consider it unless it's been 1 year.
Okay.
Because it's hard for us to know, like, what is going to be the primary home. If you just purchased it, why would you be moving out?
I normally say 2 years, but I've heard it's a year, so I just wanted to be sure.
Yeah, and the other part of that is if you live in a home that's 1.2 million and you're trying to buy a home that's 500, typically going backwards is not something that is easily explained to an underwriter, because they would say, well, wait a second, why are you downgrading your lifestyle?
Yeah. Yeah.
So you want to be careful there. I mean, there's reasons why some people will do that. I've seen people move to a different school district and have a little bit smaller home.
Yeah.
I actually had a client who lives near one of those data centers,
Okay. Mm-hmm.
and he said that he wants to move out of that house because he can hear the data center, and
Okay.
you know, it's a nice house, especially new house,
Okay.
but he just wants to move out. So it's going to be a lateral move for him, but he doesn't want to sell necessarily. He wants to be, a landlord.
Okay. Okay. All right. Anything else you want to put out there to the clients? Anything else we need to educate them?
I would just say, if I'm going to stand on my soapbox and say anything to anyone, if you are really, really just considering, but you think it's too early for you to buy a home, that you should talk to us, one of us, because there's just a lot of information that you can gather. And myself, Emerica, we're not going to try to talk you into buying a home now, but we want to give you the information so you have enough information to make an educated decision.
That's right.
I would just say, let's say that there's a lot of people that are nervous about what's happening across the United States and they just feel unsafe about their jobs. Totally understand that. But again, what's the chances of you getting another job or finding a way to pay your mortgage payment if something happens? You're going to have to find a way to pay your rent payment.
That's right.
So it's not that much difference.
That's right.
I'm buying.
Right.
So
yeah, that's right. And at least when you're paying your mortgage payment, you're paying towards your mortgage. If you're renting, you're paying someone else's mortgage for them. Thanks, Jay. And if you have any questions you would like answered, you can reach out to me directly. You can reach out to Jay Richardson. We've worked together over the years. He's one of the best loan officers out there that I've worked with because he puts his heart into it. We care about the clients, and that's one thing we have in common. Thanks, Jay. It's been a pleasure having you.
cheers.
All right. Good.